Welcome, my friends. As you may have heard, Warren Buffett just published his annual letter to Berkshire Hathaway shareholders. This letter is always highly anticipated and widely read, even by non-shareholders. The 92-year-old investor released Berkshire Hathaway's much-anticipated letter Saturday. The headline this year is that Warren Buffett pushed back on buyback critics. In the letter, Buffett called them either an economic illiterate or a silver-tongued demagogue. What does it mean for the economy? And what does it mean for the future of the United States? But before we get into all of that, please press the like button and leave us a comment below. We would love to hear from you. Please subscribe and hit the bell icon so that you are notified of upcoming videos when they are released. Warren Buffett's annual letter to shareholders is always highly anticipated. It comes from the legendary investor to his company's investors. It is released each year in February. The letter offers insights into key items of interest to millions. The performance of Berkshire Hathaway, Buffett's investment philosophy, and his views on the state of the economy and financial markets. The letter is widely regarded as a must-read for investors and business leaders around the world. The letter features Buffett's track record of success and his unique perspective on the market. It makes his insights highly valuable. In the letter, Buffett often discusses the company's financial results. That included Berkshire's earnings, its net worth, and its book value. Buffett also provides commentary on the performance of individual businesses owned by Berkshire. He also comments on the broader economic environment. Buffett also uses the letter as a platform to share his investment philosophy and principles. He offers insights into how he evaluates companies and makes investment decisions. Buffett also emphasizes the importance of a long-term perspective. He emphasizes the need to focus on fundamentals. He also focuses on the importance of having a margin of safety when making investment decisions. The letter is also known for its wit and humor. Buffett often includes colorful anecdotes and observations to illustrate his points. Overall, Warren Buffett's annual letter to shareholders is an important communication. The letter provides valuable insights into the mind of one of the most successful investors in history. It is eagerly awaited by investors and business leaders each year. His annual letter serves as a valuable resource for those seeking to learn more about investing and business strategy. Buffett believes buybacks are beneficial to shareholders. That is because as they provide a lift to per-share intrinsic value. Warren Buffett defended stock buybacks in Berkshire Hathaway's annual letter, pushing back on those railing against the practice he believes to be beneficial to all shareholders. When you are told that all repurchases are harmful to shareholders or to the country, are particularly beneficial to CEOs, you are listening to either an economic illiterate or a silver-tongued demagogue, characters that are not mutually exclusive. Buffett said. The Oracle of Omaha initiated a buyback program in 2011. Berkshire has relied on repurchases in recent years. The past few years have witnessed a competitive deal-making environment and an expensive stock market. Berkshire spent a record $27 billion in buybacks in 2021. Buffett repeatedly said that he found few opportunities externally. Repurchase activities slowed down this year to about $8 billion. Berkshire went on a buying spree with stocks selling off. Berkshire also took over insurance company Allegheny for $11.6 billion. That was Buffett's biggest deal since 2016. Stock buybacks have drawn criticism from politicians. Many believe corporate America should use their cash in other ways to boost growth in the long term. This includes employee benefits and capital expenditures. Many say buybacks often provide an incremental boost to earnings per share growth. When companies stop doing that, accomplishing that goal becomes more challenging. Buffett believes buybacks are beneficial to shareholders. That is because they provide a lift to per share intrinsic value. The math isn't complicated. When the share count goes down, your interest in our many businesses goes up. Every small bit helps if repurchases are made at value-accretive prices, Buffett said. Gains from value-accretive repurchases, it should be emphasized, benefit all owners, in every respect, he continued. Buffett highlighted Apple and American Express in his letter this year. These are two of his biggest equity holdings that have similar strategies. Buffett in the past has said he is a fan of CEO Tim Cook's stock repurchase program. It gives shareholders increased ownership of each dollar of Apple's earnings without the investor having to lift a finger. At Berkshire, we directly increased your interest in our unique collection of businesses by repurchasing 1.2% of the company's outstanding shares, Buffett said. The Inflation Reduction Act provision imposing a 1% exercise tax on buybacks became effective this year. Buffett's widely read shareholder letter is released with Berkshire's annual report. The letter sets the tone before the conglomerate's big annual meeting in May in Omaha, Nebraska. Buffett calls Berkshire's annual meeting, Woodstock for capitalists. The letter touched on a few other themes, including praise for his longtime partner, Charlie Munger, 99. As well as how Berkshire was glad to pay a large amount of taxes because of the benefit it's received over the years from the American tailwind. I have been investing for 80 years, more than 1/3 of our country's lifetime, Buffett said. I have yet to see a time when it made sense to make a long-term bet against America, Buffett continued. And I doubt very much that any reader of this letter will have a different experience in the future, he added. The much-admired investor said Berkshire will always hold a boatload of cash in U.S. Treasury bills, along with a wide array of businesses for the future. Its cash pile stood at nearly $130 billion at the end of 2022. Buffett also revealed that Berkshire's future CEOs will have a significant part of their net worth in the conglomerate's shares, bought with their own money. Greg Abel, Buffett's likely successor and Berkshire's vice chairman of non-insurance businesses, spent more than $68 million on Berkshire's shares last year. At Berkshire, there will be no finish line, Buffett said. One of Berkshire's largest holdings is Apple. What is up with Apple, you may ask? Well, something rare just happened. Barclays cuts Apple price target on concerns over demand weakness and slowing services growth. When is the last time that happened? But, when you think about it, what has Apple really invented lately? In fact, what has any big tech company really invented lately? And, Apple iPhone 14 sales are rumored to be slower than expected. And MacBook sales are confirmed to be down. Let's admit it, the iPhone 14 is really not a lot different than the 13. And a lot of iPhone users are still on iPhone 11 models. Barclays analysts said they are lowering their estimates for Apple. Analysts cite production problems and weakening demand. The analysts lowered their price target on the stock to $133 per share. That is down from $144 per share. Analysts are concerned that Apple services estimates are at risk. Barclays cut its revenue estimate by 7% for the first quarter, caused by a number of factors: slowing services growth, continuing production problems, and weakening demand. Investors are also wary of rising interest rates, and consumer confidence overall is declining. All of these factors could hurt demand for Apple's premium-priced products. Apple also faces a potential slowdown in demand. Apple has been a Wall Street darling for as long as most people can remember. Bank of America, B of A, downgraded of Apple in October to neutral from buy. The resulting sell-off vaporized $120 billion off its market cap. Apple's stock continues to be stronger than its big tech peers. Shares in Apple fell by over 25% in 2022, which is actually much better than most big tech companies. The Nasdaq Composite was down 31% in 2022. But that does not mean that all Wall Street analysts are very optimistic. Apple reportedly cut iPhone 14 production by 6 million units. Demand for the iPhone 14 in China has been slow. China is one of Apple's most important markets. Inflation is raging in most countries of the world. Central banks in almost every country are aggressively raising interest rates. And, now that there is interest on deposit accounts, investors are dumping stocks. And, if you follow this channel, you probably already know that tech companies are sensing weak macroeconomic conditions. Consumers' budgets are getting tighter because of having to spend more on gas and food. So, consumer discretionary spending is weakening. Corporate marketers are cutting their ad budgets, especially online. And ad revenue is the lifeblood of many big tech companies. Layoffs at big tech companies are big news because the biggest tech companies went on a veritable hiring spree throughout the pandemic. But the United States is now teetering on the brink of recession and the digital ad market has plunged. But, what do you think? Please leave us a comment below and hit the like button. We would love to hear from you. Please subscribe and hit the bell icon so that you are notified of upcoming videos when they are released. Please share this video on social media. Thank you for watching.